So it is February 20th, 2026. And yesterday, Klarna was basically the poster child for the AI revolution in fintech.
Oh, absolutely. They had the branding, that viral growth, the whole narrative that they were going to entirely replace the credit card industry.
Right. But today,
Hmm.
the stock is trading at $13.85. It just lost over a quarter of its value in a single trading session.
Yeah, and we have to be clear, it wasn't just a slide, it was a complete capitulation. A 26.9% drop in one day. That is not a correction. That's a statement of no confidence from the market.
Exactly. And that puts us in a really interesting high-stakes position as observers today.
Hmm.
We have to figure out if this is just the market panic selling a future banking giant over one bad earnings report.
Or if the business model itself is fundamentally broken.
Right.
Is this a fire sale, or are you catching a falling knife in a value trap?
Exactly what we're here to find out.
Yeah.
Because to answer that, we can't just look at the headlines. The headlines right now are just screaming crash and lawsuit.
They are. And that's why we need to look at the actual plumbing of the business. We're going to dissect that Q4 2025 earnings release from yesterday, look at the shifting geopolitical landscape, and really run the valuation numbers.
So we're going to strip away the noise. The mission of this deep dive is to evaluate Klarna Group PELOC, ticker KLAR, strictly through a disciplined value investing lens. We've got a lot of ground to cover, so we've structured this into 2 distinct parts, covering 7 specific chapters to keep us on track.
Sounds good. Let's get right into the breakdown.
Part 1, chapters 1 to 3, Business, Management, and Financials.
Setting the foundation.
Chapter 1, Business Understanding.
So before we get to the crash itself, we really have to clarify what this machine actually does right now. I think there's still a big misconception out there that Klarna is just a buy now, pay later button.
Right, like a glorified layaway plan for sneakers.
Exactly. But it's not that anymore.
It really isn't. It started that way. But if you look at this Q4 report, the revenue mix tells a total different story. They've built what they call a dual engine model. You've got the merchant side, where they charge retailers a transaction fee.
The take rate, yeah.
Yeah, the take rate, which came in at a very healthy 2.80% this quarter.
Yeah.
And that is significantly higher than your standard credit card processing fees.
It is, but they justify that premium because they argue they aren't just processing payments, They're basically a marketing channel. They drive actual conversion at checkout. But the second engine, and this is the one that really matters for their future valuation, is their shift toward direct interest income.
Right. They aren't just relying on merchant fees. They're becoming an actual lender.
Exactly. The data backs that up completely. Interest income hit $267 million in the fourth quarter alone. And we're not talking about late fees here. That is direct interest on longer-term loans.
Like their fair financing product for big-ticket items.
Which grew a massive 165% year over year, by the way. It really sounds like they got tired of just being a feature on someone else's checkout page and decided to build a full-stack digital bank.
That is definitely the explicit goal. Just look at the Klarna card. It's this physical and digital hybrid thing, and it went completely viral. 4 million signups in 4 months.
Unbelievable growth.
It really is. And it now accounts for 15% of their total transactions. People aren't just using it for, buying a Peloton anymore. They're using Klarna for coffee, for groceries. They're capturing daily spend.
Which is the holy grail for fintech. If you get daily spend, you win. And just to put their scale into perspective, because there was a rumor floating around about 180 million users, let's clarify that. The real number is 118 million active consumers.
Still massive.
Oh, massive. Plus, a merchant network of 966,000 partners. They processed $38.7 billion in gross merchandise volume in just 1 quarter.
But we honestly can't talk about their business model without talking about the efficiency side of things. Because this is the part that had Wall Street so hyped before yesterday's crash. They call it their ruthless advantage.
The AI shift, yeah. The headcount numbers are just staggering.
They slashed their global workforce by 49% between 2022 and 2026.
Yeah.
Half the company gone.
And the business volume kept growing. This wasn't just them trimming the fat during a downturn. It was a fundamental restructuring of how a financial company operates.
All driven by the AI chatbot. The stats in the investor deck say the bot handles 1.3 million interactions a month. That is essentially doing the work of 800 full-time human agents.
But you have to look at the outcome there, not just the cost savings. The resolution time for customer service dropped from 12 minutes down to under 2 minutes.
Oh.
Yeah. So you aren't just saving money on salaries, you're removing the exact friction that makes most people hate traditional banks. If I can solve a problem in 2 minutes on an app without waiting on hold for a human, My retention as a customer goes way up.
And that dynamic is exactly why their revenue per employee has completely skyrocketed to $1.24 million.
It's an efficiency ratio that traditional banks can't even fathom.
Right. But here's the multi-billion-dollar question. If the engine is running so perfectly and they are basically printing revenue per employee, why are investors abandoning ship? Usually, when the metrics look this good but the stock chart looks this bad, the problem isn't the machine, it's the people driving it.
Which brings us to the leadership.
Chapter 2. Management Evaluation.
This is where the narrative really gets messy. You've got Sebastian Siemiatkowski, the CEO and co-founder, and look, he is a survivor. He navigated the company through the brutal 2022 valuation collapse when the whole VC bubble burst.
He's undeniably a visionary when it comes to AI deployment.
He is, but right now, his credibility with the street is under intense fire.
Yeah, we have to address the elephant in the room here, the class action lawsuits. You don't see a stock capitulate like this without some serious legal fear spooking the institutional money.
Correct. Multiple law firms, including Higgins Berman and Levi and Krasinski, have filed securities class actions. And the core allegation is severe. They are claiming that management materially understated the risks regarding loss reserves during the IPO process.
So just breaking that down for everyone listening, investors are basically saying, you told us the loan book was safe, we bought the stock at the IPO, and then you suddenly admitted you needed to set aside way more money to cover bad loans.
Precisely. The trigger for the lawsuits was a shocking 102% spike in credit loss provisions shortly after going public.
That's a huge miss.
It is. When you are a lender, your ability to underwrite and predict bad loans is your only real fundamental skill. If you miss that mark by 100% immediately after taking public money, the market assumes you either didn't know what you were doing or you intentionally hit it. Either way, it completely breaks trust.
And in the banking sector, trust is your actual currency.
Mm.
But looking past the lawsuits for a second, I want to touch on their capital allocation strategy because it's fascinating. They use this forward flow model.
Yeah.
To me, looking at the filings, it looks like they are trying desperately to be valued as a tech platform rather than a traditional bank.
That's a very fair assessment. In a forward flow agreement, Klarna originates the loan with the consumer, but they don't actually hold it on their own books. They sell it almost immediately to Wall Street players, institutional investors like Elliott Management or Nelnet.
So they get the cash back instantly to lend out again.
Exactly. High velocity. It turns them into a capital light platform. But, and this is a big bear, but it also means they are entirely dependent on those outside buyers. If the credit market freezes up, or if Elliott Management suddenly decides they don't like Klarna's consumer profile anymore, the music stops.
It's a brilliant strategy for rapid growth, but it introduces a massive counterparty risk that a traditional bank holding its own loans just doesn't have to deal with.
And for the shareholders listening, you need to know this is a pure growth play. There are no dividends here. There are no share buybacks. Every single cent of that capital efficiency is being plowed straight back into expansion.
Which perfectly sets up the actual numbers that triggered yesterday's massacre.
Let's look at the balance sheet.
Chapter 3. Financial Health.
Context is everything with this earnings report. Let's remember, they just posted their first ever billion-dollar revenue quarter, $1.08 billion, which is up 38% year over year.
In a vacuum, that is a spectacular top-line result.
It's elite growth.
But the market clearly didn't care about the top line yesterday. They looked straight at the bottom line, which showed a net loss of $26 million.
And this is where we have to get a little technical, because I strongly suspect the retail market is misinterpreting this specific loss. We need to talk about IFRS 9.
Oh yes, the accounting nuance. This trips up so many investors.
It is the most misunderstood part of fintech accounting. Under the IFRS 9 standards, when Klarna issues a new loan, they are required to book the expected lifetime loss of that loan immediately on day one.
Right?
But they can only recognize the profit, the actual interest income, slowly over the entire life of the loan.
Let's use an analogy here for you listening to make it concrete. It's a lot like selling a magazine subscription. You pay the customer acquisition cost and the printing setup fee today, right? That hits your bank account as a hard loss immediately. But the subscriber pays you a few bucks a month for the next 12 months.
That's a perfect way to look at it. So if you sell 1 million new subscriptions today, your quarterly profit statement looks terrible because you paid all those upfront costs but haven't collected the recurring revenue yet. In banking, this is called provisioning drag.
So because Klarna is growing so incredibly fast, originating millions of new loans, they are forced to book Massive upfront accounting losses for profits that are basically guaranteed to arrive in the next few quarters.
That is the exact mechanism at play. And the proof that this is just an accounting quirk is in their cash flow statement. While the headline says net loss of $26 million, their actual free cash flow for the full year of 2024 was a positive $542 million.
Thanks in large part to those massive headcount cuts.
Absolutely. The point is, they are generating real cash. They aren't burning the furniture to keep the lights on.
That is a massive distinction to make. Solvency is not the issue here at all. They are sitting on $8.29 billion in liquidity.
Right. And their debt-to-equity ratio is roughly 100%. Now, if you're analyzing a software company, that sounds scary. But for a lending institution, 100% is standard. It's actually conservative. The balance sheet itself isn't the disaster zone that the $13 stock price implies.
So to recap part one, we have a rapidly growing cash-positive business that looks unprofitable mostly due to accounting rules, but it's dealing with a massive credibility crisis and being sued for bad IPO disclosures.
It's a very complicated mix.
It is. So let's zoom out and see how the rest of the market is digesting all of this.
Let's do it.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Moving to the macro view.
Chapter 4, market sentiment.
You used the word capitulation earlier, and looking at the trading tape from yesterday, it was pure panic selling.
The overall mood is just hostile. The financial press is dominating the cycle with words like plunged, crashed, and fraud allegations.
The sentiment shifted from cautious optimism on Monday to outright hostility by Thursday afternoon. And when you look at the technicals, when a stock breaks below both its 50-day and 200-day moving averages in a single massive gap down, algorithmic trading systems trigger automatic sell orders.
It just cascades.
It does. It's
Yeah.
trading 48% below its short-term average right now.
Right.
In trader terminology, this is just a completely broken chart.
And Wall Street analysts are basically pouring gasoline on the fire. Morgan Stanley didn't just lower their price target yesterday. They took a hatchet to it, slashing it from $39 down to $23 immediately after the earnings print.
That's a 40% reduction in their valuation model, literally overnight. When a heavy hitter like Morgan Stanley capitulates like that, it essentially gives permission for every other institutional holder to sell. It validates the panic.
Plus, the short sellers are circling. Short interest is currently sitting at 11.78%.
Which is a very high number for a mega-cap tech company of this size. It means nearly 12% of all available shares have been borrowed and sold by hedge funds who are actively betting the price will fall even further below 13.85.
They smell blood in the water. So we've got technical damage, brutal analyst downgrades, and high short interest. That's a recipe for extreme volatility. But we need to ask, who is actually holding the bag right now?
That requires a look at the cap table.
Chapter 5. Ownership structure.
This is where the risk gets structural for everyday investors. Klarna is not a widely distributed, mature stock like Apple or Microsoft, where millions of retail investors own a tiny slice. The capitalization table here is incredibly top-heavy.
We're talking primarily about Sequoia Capital, right?
Yes. Sequoia still owns roughly 20% of the total outstanding shares. And when you combine the voting blocks of the founders, Mikowski and Victor Jacobson, along with Sequoia, they control nearly 48% of the entire voting power.
That kind of concentration is a real double-edged sword. On one hand, you like to see founders and early backers with heavy skin in the game. But on the other hand, what happens if Sequoia decides this decade-long investment has finally run its course?
That is what we call overhang risk. Venture capital firms are not forever holders. They have strict mandates to return liquid capital to their own limited partners eventually. If Sequoia decides to liquidate even a quarter of their massive position, the public market simply cannot absorb that volume of shares smoothly.
You would just flood the order books, driving the price down organically, regardless of how well the actual business is performing.
Correct. As a retail investor listening to this deep dive, you have to understand that you are essentially a passenger in a car driven by 3 people. If they decide to turn left, you turn left. You have zero control, and you are entirely subject to their liquidity timelines.
That's a sobering thought. But even if the major owners hold tight and don't sell, there are massive external forces at play here that management can't control.
The macro environment.
Chapter 6. Risk assessment.
We've covered the internal threats, the lawsuit, credibility damage, the inconsistent profitability optics. But the external threat is what actually makes me nervous about this stock long term.
You're talking about the macro threats.
Yes. Higher interest rates naturally squeeze their margins because their cost of funding goes up, while the interest they can realistically charge consumers hits a ceiling. But the real issue, that the geopolitical bombshell, is the 2025 U.S. tariff situation.
This is the critical detail that I think all the flashy AI headlines are completely missing. Everyone is so focused on the tech, but at its core, Klarna is still fundamentally tied to e-commerce transaction volume.
And global e-commerce is getting dismantled by the new trade war.
Right. We have to look at the facts impartially here. The new administration imposed tariffs of up to 145% on Chinese imports. But the specific policy change that really hurts them was the end of the de minimis loophole.
Let's explain that for the listener because it's vital. The de minimis rule was a trade loophole that allowed packages valued under $800 to enter the United States completely tariff-free.
And that loophole was essentially the entire foundational business model for ultra-fast fashion platforms like Shein and Temu. It's what allowed them to ship a $10 dress from a factory in Guangzhou straight to a doorstep in Ohio without paying a single cent in import duties.
Exactly. With that loophole closed, the end consumer prices on those platforms have skyrocketed overnight.
And we are already seeing the devastating impact. Shipping volumes from those specific marketplaces are down 65%.
Now, connect those dots back to our topic. Who is the primary payment processor? The default checkout button for fast fashion and cheap cross-border e-commerce.
It's Klarna.
It is. Klarna's transaction volume is heavily indexed toward those exact high-frequency, low-value impulse purchases. If Shein and Temu see their volumes collapse by 65% because of a geopolitical tariff war, Klarna instantly loses a massive chunk of its merchant transaction fees.
So the broken model we questioned at the very beginning of the show might not actually be Klarna's fault. It's collateral damage. If the cheap goods aren't moving across borders, the payments aren't being processed, period.
And that is a systemic risk that AI efficiency simply cannot solve. You can build the greatest, fastest customer service chatbot in the history of finance, but if your core demographic stops buying clothes because they suddenly cost double, your top-line revenue is going to take a massive hit. That geopolitical reality is what makes stepping in to buy this dip so dangerous.
Which brings us to the final verdict. We've laid out the good, the bad, and the genuinely ugly. What is the actual fair value of this company today?
Time for the numbers.
Chapter 7. Conclusion.
Let's quickly weigh the bull and the bear case here. The bull case is honestly very seductive. You have a price-to-sales ratio sitting at 1.63. Just for some industry context, their main rival, Affirm, trades at nearly 5 times sales. So you are buying a company with 38% top-line growth and unprecedented AI operational efficiency at a severe clearance rack discount.
Right. The optimist looks at this and says, once the IFRS 9 accounting provisions normalize in a few quarters, and once they settle these IPO lawsuits, the core digital bank transformation is working. The stock could double and still mathematically be considered cheap.
That is the bull thesis. But the bear case is incredibly heavy. The lawsuits suggest deep structural governance issues at the board level. The tariff war is actively destroying the economic viability of their biggest merchant partners. And we haven't even mentioned that their revenue guidance for Q1 2026 was notably weak.
So we ran the numbers. You built a fresh discounted cash flow model, a DCF, based on their current trajectory and these new headwinds. What is the final number?
When we factor in the aggressive growth, the underlying positive cash flow, but heavily discount it for the legal and tariff risks, the model spits out a fair intrinsic value of $14.85.
And the stock is currently trading at $13.85.
So mathematically speaking, yes, it is slightly undervalued today. But look at the gap there. It's exactly $1. That is a razor-thin margin of safety.
And usually, as disciplined value investors, we want to buy $1 for 50 cents. Here, we are being asked to buy $1 for 93 cents. But that dollar is currently covered in class action legal fees and international retail tariff risks.
Exactly the issue. Is it really worth risking your capital for a potential 7% upside to fair value, when the downside risk could easily be another 20 or 30% drop if the trade war escalates further?
That is the ultimate question you have to answer for yourself. So to wrap this deep dive up, keep this final thought in mind. You aren't just buying a cheap tech stock here. You are making two very distinct macro bets. One, you are betting that the internal AI pivot will generate enough pure profit to outweigh the legal liabilities. And two, you are betting that the global consumer is going to just keep shopping right through a massive historic tariff shock.
It is a total high wire act. The underlying technology is genuinely revolutionary, but the macro environment they are operating in right now is incredibly hostile.
It really is a fascinating case study in how a truly great consumer product can get caught in a perfect storm of bad timing and global politics.
Couldn't have summarized it better myself.
And as always, a mandatory reminder for everyone listening to the show. This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
Absolutely. Always run your own numbers.
Thanks for joining us on this deep dive. We will catch you on the next one.